more broadly right now, how do you think about valuations? Is anything attractive?
Absolutely. If we think about where valuations are and where they've pulled back to, in particular in the last couple of days, we're actually just below 25-year long-term averages in the S&P 500's forward price to earnings ratio. And when we think about valuations at these types of levels compared to where we were at the beginning of the year, closer to 21x, when we think about forward-looking returns on a 1 or 5 year basis, the subsequent returns that valuations at these levels imply are closer to mid-single digit to high single digit over a multi-year time horizon. So certainly we don't have a lot of reasons to be bullish in this type of environment for the next couple of weeks and months. And yet when we think about the longer term perspective and the longer term investor, these are the types of levels that can be quite fruitful in the long run for an investor.
When you think about the value hawks here, the Jeremy Granthams and the Cliff Astises, they still see bubbles. Do you still see bubbles? And to the extent you do see them, where are they?
We need to be really careful about how we're looking at stocks and very much looking at a bottoms-up basis, being selective about earnings, being selective about valuations. There are still areas of froth in the market that we need to see come down, but a lot of that has taken place already. So I do think we don't want to be overly defensive or overly cautious. Yes, we want to gear towards companies with stronger balance sheets and higher quality, but at the same time, these are the types of valuations that can be, again, fruitful for longer-term investors, not only in the stock market, but in particular in the bond market, which has been a change over the course of this year.
Talk to us about duration, and what about also cash within that? Because some of the outperformance has really been in the very, very short-term holdings.
Sure. I think that we have different objectives within our bond allocation. So when we think about areas like income, and in particular, we're also thinking about areas like cash, stepping out a little bit on the duration front to some of the shorter end of the curve to pick up the types of yields that we're seeing, again, with the 2-year at 350, tends to be pretty attractive from an income perspective. When we think about bonds more broadly and wanting to add some of that ballast to portfolios, if we do start to see economic growth slow down and growth roll over, think about areas like higher quality credit in this type of environment. Again, decent income, some downside protection there. So we might be finding income and downside protection in different areas of the bond market today, but nonetheless, the opportunities we are seeing today have emerged from really 10 years of a really challenging bond market.